Ladies and gentlemen, I'd like to welcome you to that accounting panel. Every year, we get a panel together so that we can learn some of the new trends, talk about things that are happening in real time, and find out some of the pitfalls, some of the new practices, some of the new regulations. And to do that, I'd like to introduce from Marcum, a partner at their firm, Neil Levine.
Thank you, Shelley, and it's great to be back again to the accounting panel. So my name is Neil Levine. I'm an SEC partner at Marcum, serving the capital markets since 1998. So I'm one of the veterans of the trade. Today, I'm honored to moderate this panel for the 10th time since the inception of this conference. And Marcum is also a premier sponsor, so I'm really honored to be here. A little bit about Marcum. I serve on the executive committee of Marcum, where there's about 20 of us. We have the 5th largest SEC practice in the country with over 500 registrants. We have 4,400 professionals to serve the capital markets, both domestically and internationally. So currently, Marcum is the 13th largest accounting firm, and we're doing about $1.4 billion in revenue, so we do have the resources to serve. And with that, I would like to say I'm delighted to have the following panelists. I've known each of these experts for many years, and we have all served on this conference, at this conference a bunch of times. So we have Corey Fischer, managing partner of Weinberg and Company, a PCAOB registered firm. We have Neil Reithinger, who is the president and managing partner of Eventus, a CFO services firm, and Stephen Kreit, the managing partner of Kreit and Chiu, a PCAOB registered firm. So without further ado, I would like each of the panelists to just introduce themselves and talk about the services they provide and their team. Corey.
Thank you, Neil. As Neil said, my name is Corey Fischer. I am managing partner of Weinberg and Company. We are a full-service CPA firm. We're located in main offices in Los Angeles. We have offices in Florida. We have offices in the Pacific Rim. Our firm focuses mainly on the audits of the small-cap public companies. We have anywhere between 35 to 45 different public companies as clients at any one particular time. My background is formerly with the Big Four, and have been really managing partner from Weinberg for probably the last 15 years.
Neil Reithinger with Eventus. Thank you, Neil, and also thank you very much to the Crafts. Very much appreciate being on this panel. Eventus is a management consulting firm in the office of the CFO. We handle everything in that office, from accounting all the way to technical reporting and SEC compliance, and also we do a lot of work with companies on their business intelligence, which we really enjoy. So we have staff across the U.S. as well as in Canada and also Israel. We've been around since about 2008, and our staff is, I think one of the misnomers with the kind of business we're in is that, fractional CFO or pre-audit prep, and it's not just about that, because we're constantly having to evolve and be embedded with our clients and actually be not rotate staff and actually understand their business and so on. There's a shortage of staff and so on, and we want to be able to fulfill that need for them. So we think we do that pretty well with the office and supporting the CFO, and as well as the two gentlemen to my left and my right, so that we can be accretive to the whole audit process. Thank you.
Hello, my name is Steve Kreit. I'm a managing partner at Kreit and Chiu. My co-founder and chair, Joanne Chiu, is here as well. We are a fairly new firm. As a matter of fact, tomorrow will be our 3-year anniversary. We started May 1st, 21. Right now, what we do is we focus on audits of public companies. 95% of what we do is audit work, and 95% of that is working with public companies. We work with public companies, any phase. We've done a bunch of IPOs in our 3 years. We work with existing issuers and work with them throughout that process. Half our clients are international companies that are looking to go public and raise money here in the States. So we have clients in China and Singapore and Indonesia and India, and working on getting clients in Canada and South America, and the list just goes on and on. We are a 100% remote firm, so all my people work where they are. Thank you.
Great, guys. So let's start it off with a great question. Corey, you could lead it off, but I'm sure the other guys are going to pitch in. Regarding the PCAOB, what's going on with the regulation, enforcement? What's it doing to our audits, and what's it doing driving up our fees?
Well, thanks, Neil. That's a great question. And normally when you're speaking at a conference, you can talk about accounting updates and the things that affect the users of the financial statements. But in the last couple of years, there's really been a change in the dynamics. We have a very active and aggressive PCAOB that has really forced changes on the profession, in which those changes are really being pushed down to the companies that hire us as auditors. Really, it's two things. Auditors' reactions to the PCAOB's inspections, and what they're now calling sweeps, where they go through and they find firms and for what appear to be just simply administrative matters. And then more importantly, and maybe more of interest to the registrants, is going to be the new pronouncements that they have about what they want the auditors to do. But first, I just want to kind of go through what's happened with the inspection process and with the enforcement. Inspections are always difficult for the firms, but it seems like in the last few years it's become more difficult and very frustrating for the member firms. Any area where significant judgments have to be made by the auditors, such as impairment testing, valuations, reserves from inventory, those are looked at by the PCAOB and very well scrutinized and put the auditors under a lot of pressure to support their judgments and documentation. Lots of times firms will tell their clients, you need to go out and have a valuation. The registrant will go get that valuation done, but then the auditors have to bring in their own valuation people. So now you have almost like a double cost there for the auditors. The current PCAOB head has background in enforcement, and that's really where her drive has been over the last 2 or 3 years. You may have noticed that the PCAOB systematically issues these press releases announcing the completion of sweeps. They're mainly focused on findings of administrative matters, such as audit communications, incorrect reporting on Form AP, which is a form the auditors use to report to the PCAOB of the audit that they completed. Nobody really reads that except for the PCAOB. Creation of independence violations, where probably none really exist. So these types of things all kind of overhang the auditors, and we have to be very careful of them. PCAOB is now instituting fines at will to the firms. There's no real guidance or precedence for these fines in the past. There's no list of what these fines will cost you, in a guidebook. So overall, it's created a very difficult environment for the small cap firms. And as a result, the audits have become more costly, and auditors have become scarce. Firms are focused on spending time on work paper documentation that's completely invisible to the firms that we audit. We've got to spend time documenting significant judgments. We've got to document things that are basically obvious, but we got to spend our time doing that. If you have noticed, there's a number of very good firms, somewhere between the top 10 to 25, that just no longer do the public work. And it's just gotten too much for a lot of the smaller firms to deal with because of this oversight and because of this constant threat of enforcement. Going forward, there's a couple new pronouncements out there. You may have heard of them. Most significantly, the PCAOB is proposing a new rule on auditors reviewing companies' non-compliance with laws and regulations. This rule would make auditors expand the procedures to identify laws and regulations with which non-compliance could have a reasonable material effect on the financial statement, and expand our procedures indicating whether there's information indicating non-compliance. So as you could imagine, auditors are not lawyers. We have no training in this, but this is where the PCAOB wants to lead us. So you can imagine the significant cost that this would bring to the companies. So there's other audit proposals out there which would increase the number of the amount of reporting that the firms have to do to increase transparency. Again, doesn't invisible to the companies that hire us, but just another thing that we have to deal with, and really, at the end of the day, will just be another target for the PCAOB to find non-compliance with not filing a form. So it's become very tough. Fees have gone up. We have to spend a lot of time doing testing, things like journal entries, which in smaller cap companies really have no effect, but take us a lot of time to do. So it's going to be a very difficult environment.
Yeah, I just want to add that, you know, in the old days, you would have the lawyers, or you would have the bankers, you would have the companies really putting pressure on the auditor, like, hurry up, Levine, get this done, and it's just not like that anymore. So I have a question regarding PCAOB to Neil. Neil, so the remediation, so you guys do a lot of the internal work. We take it, we do the audit. You know, what are we supposed to do with the remediation? Do you get involved in that to help the companies? I mean, what the companies, they care about costs, and this is completely driving the cost out of control. Can you make a comment just on remediation or work paper preparation, like what you're seeing?
Oh, sure, and we get involved in that, yes, and that is that's a task, and that's obviously something that is a big need that we obviously have to embed ourselves in. But I think, I mean, the problem with this is that, you know, it's affecting capital formation, right? You're driving all these. Well, a lot of people don't want to do accounting anyway, right? But it makes it even worse, because the fear, the burden, and so on audit firms. And yes, we can do the work and we can help companies remediate some of these issues, but it's moreover, where does this end? I think it's unsustainable. There is one of our SEC directors, we used to be with the PCAOB, and is very thoughtful about this. And she says, you know, look, there's a lot of comments that have no structure. There's a lot of variation between staff. There's no consistency in the convention there, which she, you know, feels that is another impediment. And there's no cost-benefit way in which they're going about this. This is all a fine-driven environment, you know, and finding any little thing that can go wrong or be wrong with any particular firm or audit. And therefore, what, like Corey was mentioning, it's causing smaller firms, it's an inability for them to adapt. And what's happening too is that the larger firms it's becoming much more expensive, right? So, I mean, I think that, I think they could implement a more, first of all, I think they have to get away from a fine-based approach. And I think that it should be a risk-based approach as well. And I think that proportionate oversight is important too, because I think auditor's an auditor, but at the same time, there's complexity with larger companies as well that are in the level of materiality and the level of oversight over those for larger firms is certainly going to be a burden they have, but they have the resources for that, right? So you know, I think that even though what these firms have to do, though, and this is getting back to the thoughtful way in terms of I had these discussions internally, is there are remediations that the audit firms themselves need to fix from year to year. And this is another thing that one of our team has pointed out when they were there, is that, hey, look, if something's pointed out and it's not fixed, it's not just a, you have to actually make corrective measures to do that, just like an issuer's material weakness or what have you. You have to actually, it has to be in fact something to implement so that it doesn't recur from year to year. So I mean, that's a very, that's obviously there's valid arguments, but on that side for the PCAOB and what they need to do, but the way they've gone about it, I think, is affecting capital formation for companies because there's fewer auditors.
I think it's affecting capital formation. I think it's affecting, companies going public. I mean, you talk about, a fine-based system and the press releases that are coming out and how the PCAOB is proud of the amount of money that they're fining audit firms. They're proud of the fact when they remove auditors from practice, and there's been a lot of that over the last probably 2 years. People who are never allowed to practice in front of the PCAOB or can't for the next couple of years. And listen, there's always bad actors. I'm sure there are stories out there of firms who were not doing the right thing, and the regulators were doing the appropriate action. But I think that at least in my opinion, they've certainly taken things very far to the extreme. I've been doing this for a lot of years, and I talk a lot about the pendulum. It really depends on a million different things of where the regulatory environment is, but it's a pendulum that just swings back and forth. We are so far up at the extreme on one end of that pendulum right now. It continues to make things very difficult for firms. And then if it makes things very difficult for firms, it makes things even more difficult for issuers because it affects them. We are constantly in the middle of inquiries from the PCAOB. And the interesting thing is we work with an attorney who's very experienced in this, and he said to me last week that it's easier to deal with the SEC than it is to deal with the PCAOB. And so for the issuers out there, you could imagine how difficult that could be. So it's really a tough environment out there. It really is.
Thanks, Steve. So Neil, with all this regulatory we've been talking about, and there's a shortage of accountants, what do you put into, how do you choose an auditor for these registrants today? What are some of the criteria that, you're from the other side, what criteria do you look at to pick auditors or refer auditors to these registrants?
Is their last name Levine?
Yeah,
okay,
that's
me.
me.
Well, I'd stay away from those. But, no. Well, first of all, sheer size and complexity of a company, right? The sheer size, the complexity, transactional volume, and so on is going to dictate to a firm and their resources and ability, as well as geographical too, in terms of how they can scale with a company, right? So can't ignore that. This is especially true for FPIs because FPIs need to, when there's any international operation, the scope in terms of what the reach of a U.S.-based auditor can do drops dramatically, and the populace of firms that can do that drops dramatically. So I think that we have to take in first and foremost what the right fit is. Optics, I think it's not as big of an issue, but sometimes there's optics. Let's say larger IPOs, who's on the cover. They want to know that could be a very, very large IPO. It's got to be a big four and what have you. It doesn't necessarily be that at all. We don't run into that a lot in our arena of the small cap, but nevertheless, it is a consideration depending on the size of the company. Then there's timing and bandwidth. I think that this is something issuers need to ask because of what's going on with staffing is, do you have the bandwidth to be able to, all things being delivered on time, because some companies obviously have to, where firms like us come in and be prepared for that. But given that, do you have the bandwidth and the staff to be able to do this on a timely basis? And timely is something to define as well. Well, what is timely? Timely is, if it's a 12/31 year end, obviously, and there's crunch time for 12/31 year ends, everybody loves an off year for a fiscal year. But at the same time, there's gaps in between periods of reporting and so on. Is your staff able to do that? So I think that has to be a very explicit question. I think people have to be intentional when they're answering that so that they know. Then interplay on accounting issues. Obviously, auditors have to be independent. They can't collaborate with the company and so on. And companies need to be prepared to actually present their issue and to be able to present it to the auditor that's thoughtful by way of a memo or otherwise, or other technical analysis, and not rely on the answer from the auditor. But nevertheless, there still has to be a level of interplay there where they know and they feel comfortable with the engagement partner that they can talk through this knowing that they presented their case, because they could be wrong. and there can be a discussion there. So I think that discourse is very important. And there's a way to do that that does not have an independence issue, right? So, but I think companies need to make sure they have their position first. Then there's industry and others. Some auditors can't do certain industries or don't want to, right? And that's completely fine. That's sometimes a business decision, but certainly if they can't, that's obviously something they have to be very explicit about that they can. And then of course there's price. And everybody probably wants to hear price first, and it really should not be the first consideration, because right now the price of small to large are being driven up just in general. It's really, if it's the primary driver, I think the path to selecting an auditor is going to get lost. You have to kind of go through these other criteria, and certainly if there's a price that completely blows a budget out of the water, I think that that's obviously never something that a company wants. But I think within reason, these things are priced on a risk-based approach, and they're priced accordingly. And I think that is a major consideration, but it shouldn't be the first. Okay.
Thanks, Neil. Steve, can you talk about some of the accounting industry trends and how they're affecting the issuers in the room?
Sure, happy to. Thank you, Neil. So there are a lot of trends within firms that I mean, we've spent a lot of time talking about the PCOB and how that's affecting issuers, but there's other trends in the industry as well. Mergers, I'm sure everybody has heard there's been a huge increase in accounting firm mergers. That absolutely affects the number of firms that are out there that'll do PCOB work. That'll also, a lot of times, a lot of the smaller firms are being acquired or merged into larger firms. When that happens, Marcum is a great firm. They have a huge public company practice, but small microcap, very small microcap, the lowest end might not be the right size for a firm like that. And as more firms, as they merge in more firms, as other big firms like Eisner and other firms get PE funding and continue to merge in more firms, there's just less accounting firms out there. There's less PCOB registered firms that could serve different issuers. Another trend, and we spoke about this, Neil touched on this briefly, is staff shortages. So there's been a huge decrease in accounting graduates. From 2012 to 22, there was about a 17% drop in students, in people graduating college with an accounting degree. In addition to that, there's just been less and less accountants out there. Everybody heard, during COVID about the Great Resignation. That really affected accounting firms a lot. There was, since 2022, there's about 15% less accountants or accountants that have left the market, left the public practice. All of those trends, again, continue to affect the issuers. There's just less firms, less people. That makes it just more difficult for audits to be done timely and really to be able to effectively serve clients. We talked about firms leaving the PCOB. There have been individuals that have been suspended. There have been firms that have been suspended. There are firms that are leaving the practice voluntarily, in addition to the involuntary ones. Briggs & Valseca was a firm that was out there that did a lot of work, a lot of microcap companies in China and other international areas, and they merged into Crow, and Crow was not interested in doing that work. So, and there's just a lot of stories about firms just kind of walking away from public company practice. In addition to that, firms are making huge investments in technology to help offset some of these staff losses. They're also investing more in work-life balance. And all of these trends is just the amount of hours that are out there to service public companies. These will all continue to push audit fees higher. It's going to have that effect. There's really no way to change that. There's going to be less firms to choose from. I think there are a few keys for issuers to deal with this. Obviously do your homework and pick a firm that does have staff and does have availability and can hit their deadlines. But it's also incumbent on issuers to be more organized. I made this point last year as well, but in the microcap space, just about every microcap company should have a CFO advisor, should have an Eventus or an equivalent that could help them get organized, help them write the memos, make sure they're ready when the firm staffing is in place. These are things that just make the process go better all around and on both sides.
Neil, just a quick comment. I just want to, about the investment or consolidation, PE coming in and consolidating firms. I don't think we can ignore culture. I mean, people want a place, you said work-life balance, people want a place they enjoy going to, right? And the less that occurs, the more they're not going to be in the profession, right? So, your former firm had a, consolidation and was the product of an investment. Maybe some of that culture disappeared. I think that's critical too, because if you look at any comp standards, comp is like number 4 or 5. One of the first things people say about who's my boss, my direct boss, that's the number one thing people want. And then in the 2 or 3 is the culture and tribe whole aspect. So I think that's very important. Okay.
Yeah. Okay. Thank you. Corey, you there?
I'm here.
Okay, good.
I'm waiting.
Regarding
Waiting for the next
SEC comment letters that you've seen, what are some of the hot topic buttons you've experienced over the last year?
Actually, the number of SEC letters, comment letters, has actually increased dramatically over the last year, and particularly as it relates to the smaller registrants. And they kind of fall into the 2 groups. There's the big ones are the 2 biggest sources for comments have been on the MD&A, management discussion and analysis, that the companies are putting in. They're just too robotic. They're not telling enough information. They need to be more robust. And if sales went up, why did they go up? Product mix, number of stores, whatever. The other big comment area has been on non-GAAP financial measures, and that's one that the SEC has been hitting pretty hard on. And they've actually had a couple enforcement actions in the last year or 2 related to the non-GAAP financial measures. Companies are still trying to put through things into non-GAAP financial measures that don't belong there. As far as accounting goes, the 2 biggest comments really related to segment reporting, which, and by the way, there's a new accounting pronouncement out there, so that's going to change in the year or 2. And then the other standard comment is always, revenue recognition. Companies, SEC always has questions on the revenue recognition.
So what gives rise to a comment letter? Is it just routine filings, Corey, or is it an S1, or
believe it or not, but most of the issuers don't realize the SEC reviews your filings every 3 years, whether you know it or not. So when they're going to go through and do a review you don't know about, they're going to look at things that are on their hot button, which is MD&A right now, and non-GAAP, these measures, and any time you have a different accounting policy or a different accounting issue, they're going to ask questions.
Thanks. So they want me to go to Q&A, but I'm not ready. Neil, I want to get this one question out before we go to the Q&A. With the big boom that we saw with the IPOs in 2001 and a little before then, what guidance are you giving your clients now on how to navigate the current financial markets?
Well, we try to be very helpful with regard to how they manage their expectations. And we actually are pretty deliberate as well with making introductions. We're not money raisers, we're not bankers, but we need to be, in the nature of what we do, connected to where the capital markets are so that we can fulfill that role, right? We tell them, obviously cannot control structure or valuation, and you may only get one shot with a banker or an investor and so on. So I would say, what's important is to say how is the business executing, making sure that they are on top of how their business is executing unit economics. Is it off plan, on plan, and why? Do they have defensibility with respect to their business so that they can present that with regard to their TAM, and also how they're able to show the value prop of an investment and use of proceeds therefore, right? What are the expectations on valuation? Sometimes they're way off, right? We try to make sure that there is a realistic approach to that in terms of what the valuation metrics are, what they could be, right? So that they're prepared for that. Their cap table, right? So that you can never be short on dissecting cap tables and making sure they're clean, dilutive securities, who's on the cap table, who's involved with the company. You know, obviously, these things are going to come up in due diligence. It's not like, you know, and even if companies aren't intentional about withholding that, it's not the point. The point is you just have to know that it's not a matter of waiting for a question. It's just to be full disclosure on it so that you know and you have a clear path and understanding of what to expect for, you know, in terms of raising money. And then financial controls. You know, this is not something, financial controls being, you know, your financial process, right? You can't fix this acutely, right? It's a process over time and so on. And clearly it's not just about raising money. It's something companies need in general that they have to have as part of running their business, right?
Okay, Neil, got to cut you short.
Okay.
They want to do a little Q&A. We've only gotten through half of our program. Should we go another hour? We can. No, okay. So, okay. Questions and answers. Mr. Bernstein has a question. Not to me, I hope. The answer is yes. Any other questions?
No, I'd like to make just 4 quick points.
Yes, Mr. Bernstein.
Number one, I think you four did an excellent job.
Oh,
I
well,
think
thank
you
you.
covered a lot of ground. Number two, obviously I get to speak also, and when I'm on these panels, the most common question that comes from the audience, I figured I'd ask it on behalf of them, is why does my report take so long? And I think for the audience, they've kind of answered those questions, and the reason for that is, one, obviously as auditors, we probably could do a little bit better job in getting it done quicker, but the environment has become so toxic, and as they've mentioned, I've seen more people lose their licenses in the last 3 or 4 years than the last 30 years. So you can imagine when these auditors are working, and they realize that they can lose their license if they don't do a good job, they take more time. One of the ways to avoid some of these problems, as they mentioned, is using firms like Neil's, internal accounting firms, is invaluable. Certainly, you know, a good internal accounting firm can discover lots of problems before you get the expensive lawyers and accountants involved. So whatever you think it's going to take to get your audit done, it's going to take longer than you think. And lastly, I guess you touched upon choosing an accounting firm. I kind of have a unique way of looking at it. When you're buying an audit, you're actually buying 2 things that have nothing to do with one another. Number one, you're buying the audit. And the truth is, whether Pricewaterhouse does it, or my firm Marcum does it, or a sole practitioner does it, if everybody does what they're supposed to do, and it's accepted by the regulators, you're pretty much talking about differences in labor rates. The other part that you're really paying for is you're renting the firm's brand name, reputation, and credibility to go market your stock. The Big Four have the most valuable brands, and that's why they're the most common, and obviously they also have the bandwidth to do the big companies. But a Big Four firm hasn't caught a major fraud in 25 years. So if you think that's going to work, it's not. So I just wanted to, you know, make those points.
Thank you, Drew. Anybody else? We have 5-10 minutes left. Yes.
I'd like to echo great panel. I have a question on non-timely financial filings. So if we're on the other side, we're not an issuer, we're not an auditor, we're an investor, and we see one of these dreaded announcements that the company's filings are not going to be done on a timely basis, you call the company, and guess who they always blame? Sometimes they'll give you a clue, you know, we have to restate our financials, but how should investors interpret an announcement that the financial filings are going to be not going to be done on a timely basis?
Go ahead, Corey.
That's something, you know, case-by-case basis. If you're following the company, you probably know there might be some issues in the company. Obviously, if you call the auditors, we're not going to be able to tell you anything. That's just a hard one, you know. Companies have investor relations, you know, groups that answer questions. It's just, that's impossible to give you any guidance unless you
Yeah,
guys.
I
mean,
would
the
say,
biggest, so I think the biggest thing, there's a lot of different inputs that could cause a financial statement or a filing to be late. I think it's hard to make an assumption just because there's a late filing. It could be the company's fault, it could be the auditor's fault, there couldn't be enough staff, an accounting issue could have popped up in the last minute that no one knew about. There's different things that could have caused that, so it's very hard to say, oh, it's always this, always worry.
Well, let me pin you down. From your experience, what percentage of the time is the auditor's fault that they just couldn't get their work done?
Never.
And what
It's
percent?
it's never the
What
auditor's
percent of the time the company's fault?
Well, I think what's happened is, and this kind of goes to, Neil, you want?
A good public company literally owns 80% of their investors' trust and confidence. The other 20% will never like you, and sometimes if they hate you enough, they can create opportunities for the other 80%. But now you're talking about good communication on the company's part. And if the company owns that 80%, and if they communicate well, then that shouldn't be a problem. If it's bad news, they'll tell you the bad news. And if it's, news that's not so bad, but, something's late or something, then they'll tell you, and it's not an issue.
thank you, Drew. We have one more question. Time for one question in the back. Mr. Lukoski, stand up and show us that green jacket. Oh, here it goes.
You'll see it
Levine,
soon enough.
Levine,
Thank you, guys. Great panel.
why are your prices so
Great
high?
panel.
Go
I
ahead.
have two quick questions. One is following up on Steve's conversation about the PCOB and tough regulatory environment and seemingly wanting to fine auditors. Why does it seem like the PCOB is only going after the big guys or the name brands or the people that we know have good audit procedures, good controls, good national offices, and are letting some of these fly-by-night auditors that we all know in the industry continue to do audits, 100 audits plus with no staff, complete disaster. We all know it's coming, but when are they going to crack down on the real problem in the microcap industry, not the larger big brand name firms like we all know? And then secondly, can you talk, because we see this a lot, we represent, dozens of New York Stock Exchange and NASDAQ companies, and the question that we always hear from our clients and boards and audit committees is, what is the difference between audit firms being able to not prepare the financial statements, but still give the CFOs and outsourced people the ability and comments and notes and guidance to, sort of deliver the right package for you? It seems like in this regulatory environment, every audit firm is afraid to give informal guidance, afraid to touch the footnotes, afraid to look at the MD&A until it's absolutely perfect and absolutely completed. And how can we better as a community facilitate that process to get audits out more timely without this awkward back and forth of, we can't do that, you can't do that, you have to do it, we have to do it?
Thanks, Joe. Steve, you want to take that last part from Joe? I mean, it's a little simpler than the first part. What was the first part, Joe?
Actually,
I actually thought
I
the first part was a little easier, but that's just why.
I think the first part about why some of these firms are not are being able to continue to practice really has to go back. As a lawyer, you would know that the SEC. If you have a case in front of the SEC, it's taken years now to adjudicate it. There's been a couple other firms that we knew were in trouble with the SEC. It just took forever because it's like a 4 or 5 year process. I'm not sure exactly what the PCAOB has a little bit quicker timetable. So that's, I think, the reason for it. And as you know, a couple years ago, there were a number of firms that did have administrative matters in front of the SEC, but then the SEC, all those cases got thrown out. So it's frustrating to all of us because there's a few bad apples out there that are responsible for a lot of the lesser quality work, but it falls on the small cap group as a whole.
And then what happens is when we do take over, more often than not, we may find things that may come down to a restatement. So as Neil said, really quiz your audit firm and just make sure you know what you're buying, as Drew said. Anyway, they're telling me to wrap it up. It's been great to be back here again. Should we continue this on the outside lawn? That's what she said. But anyway,
The good
thank
news
you.
is, they're all of these people, wonderful accountants are all sponsors here. If you have more questions, they'll be around that you can ask them anything you want to ask.
Pleasure.
Sorry we didn't
Pleasure
get
to
all
be
of
here
you.
again, Lulu. Thank you.
Thank you, guys. That was great. Thank you.